Hey, folks. Welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update is for Monday, June 21st through Friday, June 25th, 2010. Well, let's get into the charts. What you're looking at right here is a daily chart of the SPY, which again mirrors the S&P 500. And the reason why we're looking at this daily to start out, because I want to show you the general pattern that you're forming on the daily chart. You do have a little bit of sideways consolidation above the 200 moving average. Now, the one resistance area we've been dealing with is the 112 level on the SPY. You can look at the SPY close on Friday at 111.73. Granted, it was after a dividend of 50 cents was paid out, but regardless of that, that has to be looked at as sideways bullish consolidation in the short term. Now, just in the very short term, and I want to make that clear. Now, a couple other things to go over. As we look at this daily chart, the levels on the upside, 113, and then ultimately about 114 and a quarter, which is the 50 moving average. Those are your upside levels. Now, if this pattern failed, if the bullish pattern fails to the downside, what you're going to end up seeing is a move all the way down, most likely to this level down here at about 110.75, and then a possible pullback to the 20 moving average at 109. But granted, this pattern again gives us a small upside bias for early in the week, and we'll see how that progresses. And again, this is just following the price pattern and timing of the methodology of In the Money Stocks that we teach our subscribers. Research Center, chat room, webinar participants, that's what we go over. And again, you become a master of this, you make more and more money, bottom line. Now, let's go to the intraday charts. Last week, we had options expiration. Options expiration played out perfectly here, folks. All right, what do I mean by that? Well, the first kind of last 4 to 6 weeks, we saw a massive move down until about a week and a half ago. And if you go to the chart here and we scan back, and I'm going to scan right now back here on the charts to mid last week, you can see we were all the way down in the doldrums here, going all the way back to about the 8th of June, hitting a level of 104.50. Now, at 104.50, I went into a positive bias, and I said to my members in the Research Center nightly video, I said, as long as this market holds 104.50 on a closing basis, go to the long side and start accumulating long positions. I accumulated long positions. I gave the alerts as I accumulated long positions, and sure enough, 104.50 was where this market was a few weeks ago, or about a week and a half ago. And then we look at today's market price and we say, wow, what a move, all the way up to 111.75, basically a 7-6% move in the markets to the upside. And if you look at the last couple days, and I'm going to scan out here a little bit, you can see that really since the move up here early in the week, last week, Tuesday, Monday, Tuesday, the market went choppy sideways, very choppy sideways. We should all know that pattern is a slight in spirit of bull flag. Now, again, that gives us a short-term upside bias, nothing more than a short-term upside bias, in my opinion, as the market still has tons of problems. Europe has tons of problems, and there has to be looked at the bigger picture here and see that there are still things that are majorly wrong. Now, we've come back a long way, 7% bounce. Could we get a little bit more of a bounce, maybe a 10% bounce? Yeah, it's possible. It's possible, but at that point, I would go into a very, very secure, safe mode. I've already kind of maneuvered myself into a fair majority of safe modes, being in a lot of cash now that we're already up 7% off the call of going long. There's still a few long positions out there that I like. There's still a couple long positions that I may pick up, but overall, it's very, very minor, and most of it's in cash until we get the signal that the market has topped out, maybe off of another one more move up in the market should we get it. Now, again, notice the consolidation here on Thursday and then Friday. Notice a little bit of a triangular pattern here. What you're going to essentially look for if we start out on Monday right around this area, you're going to see which way does it break. Whichever way it breaks, you should have a decent move up or down in that direction. Notice again the lower triangular patterns connecting these lows for the last 2 days, and the upper triangular pattern connecting the highs from really the close on Thursday all the way through all the highs on Friday. Now, volume again was extremely light. Options X, the volume died out. We had our lightest trading day in volume probably in about 2 months on, maybe even more, maybe 3 months on Friday. Options expiration, folks, the lows being put in a week and a half ago. You have to understand the institutional game here. I've discussed this in depth with a lot of my members here at InTheMoneyStocks.com, in the Research Center, in the chat room, and even to some extent in the webinar. But bottom line is, you have to know that on options expiration, the institutions are always the ones selling the majority of the puts and calls. Therefore, whoever buys the most puts or calls, whichever side is over leveraged, essentially, you know, if more people bought puts in the last 2 months, which again did happen, obviously, because the markets were collapsing, so the retail investor buys more puts, then the institutions will generally run the market in the opposite direction, right into options X, which is exactly what they did. We just talked about that 7% up move in the last week and a half, and that's the institution institutional money, just slightly pushing the market up so those puts expire worthless, and therefore the institutions get the premium. I mean, it's a simple game here, folks. It doesn't take a rocket scientist to understand what goes on in the options market, okay? That's why, again, I'll play options, but very, very seldomly, very carefully, and I don't hold into options X. It's just one of my beliefs that if you do that, you're putting yourself, obviously, at a very big disadvantage. You try to get them early and get out of them long before options X comes into play. All right, now that's what we're seeing here, folks, again on the market. You can see beautiful little consolidation. Here's a little double top area on the spiders in the short term at 112.35. If you break above this blue line and then you move into this will be resistance. If you get through that, 113 is the next level on the upside. On the downside, obviously, if you take this out, 200 moving average, and then I think we could really fall all the way into the double bottom here at 111, really 111-ish, 111.10, and ultimately if we do break down here below the 200, it could go much, much lower, but I still have a slight positive bias. Now, a couple things I want to talk about. What's the big news over the weekend? The big news over the weekend is that China is to loosen the Yuan peg. That's huge, folks. And why is that big? Because all of a sudden, generally, if you loosen the yuan peg to the dollar should weaken. What do we know about when the dollar weakens? When the dollar weakens, let's take a look at the UUP chart here on the daily chart. It's a great chart. Here, over the last week and a half, the dollar's fallen. What do we know about the markets? The markets have gone up in the last week and a half. So we know that if the dollar falls, the markets go up. So this also leads me to believe that there's a possibility of an early week possible move up. We're going to find out tonight when the futures open on Sunday night at 6 p.m. Eastern time. But the yuan peg, again, if that's loosened, now it's not loosened by much, but it should be enough to obviously cause a rally in China and also a possible rally across the globe as the dollar may get hit a little bit as the yuan is again pegged or kind of taken loosened against the dollar. Now, overall, what does that mean? What should we be looking for early in the week? Chinese companies with exposure that import a lot of materials. For instance, one of my favorites, and those of you in the research center and chat room, you guys know this one. I think this is a great play right now based off of this news. We're going to find out tomorrow. There's still a fund unloading, but if that fund finishes up, I think this thing rocket ships to the upside in a major way. CNAM, China Armco Metals, this company imports from South America all over the globe metals into their country. Now, if their currency is stronger, they're going to have cheaper importing costs. Essentially, if their currency strengthens to import from Brazil or from Argentina or wherever they're importing these metals, they should be cheaper because their yuan is strengthened. So that could be a very, very big play here and a possible squeezing opportunity on this CNAM. Now, there's other plays out there as well. Anything that imports, that does that kind of stuff. Also, if the buying power of the Chinese population increases, you're going to look for a possibility of the overall populace of China to start buying more. Therefore, it could, consumer stuff in China. I mean, it really could have a positive impact across the board on this China. I do expect China to rally tonight, folks, on this, and I do think it does help a little bit on the side of the U.S. markets early tomorrow, but we'll find out again. I mean, it's going to be a very interesting thing to find out in the futures market tonight, and does it last? How long does this last if we see it? And again, maybe we won't see it, but I do think right now you have to give the bias to the slight upside based on this news out of China, all right? Now, early in the week, folks, just to finish up here, you have a Federal Reserve meeting on Wednesday. They'll announce FOMC rate decision. That's Wednesday, 2:15 p.m. Eastern time. There's some other housing data this week. There's a few little odds and ends, but nothing major. GDP comes in later in the week, but that's the third estimate as well. But again, watch the Fed's comments here. Are they showing any signs of tightening rates, or are they just going to stay pat? Watch the dollar, how it reacts. Watch Europe. Continue to watch Europe, folks. Any new rumblings of defaults in Europe, that will hurt the euro and raise the dollar. So you have to be on point here with currencies. Currencies are a big point of where this market will go. All right. Again, just going to the intraday chart here on the spiders. Let's punch that up. There's your spiders chart. Watch this very carefully. We'll see how things go. But nonetheless, folks, it should be a fun week. We're going to make lots more money, again, as we've been doing nonstop over the last multi-month period in this market, and it should continue with the volatility as well. Take care. Come join the Research Center. Come join the chat room. We'll see you there to make some money. Take care.